The Pi network started with a very simple and powerful idea. What if anyone could mine cryptocurrency right from their smartphone without needing expensive computers or draining their battery? This concept, launched back in 2019, attracted millions of people around the world, all tapping a button on their phones each day to accumulate Pi coins. For years, these coins existed inside a closed system. You could mine them, you could see your balance grow, but you couldn't sell them or trade them on the open market. It was a project built on patience and the promise of future value. The launch of the open Mainnet in January 2026 changed everything. This event was the moment that the entire community had been waiting for. Think of the enclosed Mainnet as a practice arena. It was a real blockchain, but with high walls around it, preventing any interaction with the outside crypto world. The open Mainnet launch was the day those walls were finally torn down. This crucial step connected the Pi network to the global financial ecosystem, allowing Pi coins to be listed on cryptocurrency exchanges and finally given a real-world market price. For the first time, the digital coins on millions of phones could be converted into dollars, euros, or other currencies. So, what does this open Mainnet truly signify? It means the training wheels are off. The network is now live, public, and decentralized. Before this, the Pi core team had to approve which apps could use the network and no external wallets could connect to it. Now, developers can freely build on the Pi blockchain, and more importantly, exchanges can list the Pi coin for public trading. This transition from a closed, experimental project to an open public utility is the single most important event in the Pi network's history. It is the moment when its theoretical value is finally put to the ultimate test of the free market. For the millions of users, known as pioneers, who have been diligently mining for years, this is a monumental milestone. Their daily taps have finally led to a tangible asset. The question that loomed for so long, what is Pi worth, was no longer a theoretical debate. The launch meant that the answer would be decided not by speculation or promises, but by the raw forces of supply and demand on a global scale. It marks the beginning of a new chapter, one filled with both incredible opportunity and significant risk for everyone who holds the coin. When a project like the Pi network with over 60 million users finally opens its doors to the market, one of the biggest factors to consider is supply. Imagine a huge dam holding back a massive reservoir of water for years. The open Mainnet launch is like opening the floodgates. Suddenly, all the Pi coins that have been mined and migrated by millions of verified users become liquid. This means every one of those users now has the ability to go to an exchange and sell their coins for the first time ever. This creates an immediate and potentially enormous wave of selling pressure on the market. This risk of a massive sell-off is the central challenge for any new cryptocurrency launch, especially one with such a large and diverse user base. Many early adopters might have been mining with the sole intention of cashing out as soon as possible. They might need the money for personal expenses, or maybe they simply want to realize the profits from their years of patience. When a huge number of people try to sell the same thing at the same time, the basic laws of economics kick in. If there are far more sellers than buyers, the price has nowhere to go but down, and it can happen very quickly. On the other side of the equation, you have the buyers. Who would want to buy Pi at launch? This group could include media group, young adults on laptops reading cryptocurrency news, people looking at digital currency charts a stock would distribute swap equally, crypto investors who missed out on the initial mining phase and are speculating that the price will go up in the long run. They might believe in the project's vision of creating a widely used digital currency. Others might be attracted by the hype and the sheer size of the Pi network's community, betting that such a large user base will eventually create real value. These early buyers provide the initial demand that helps absorb some of the selling pressure from the miners. However, many potential buyers may choose to wait. A cautious investor might look at the situation and see a high risk of a price crash right after the launch. They might decide to sit on the sidelines and watch how the market behaves in the first few days or weeks. They are waiting for the initial volatility to settle down and for the price to find a more stable level. This wait-and-see approach is very common, but it also means that the initial buying power might not be strong enough to counter the flood of coins hitting the market from early miners who want to sell immediately. The Pi core team was well aware of the risk that a massive sell-off could crash the price on day one. They didn't just open the mainnet and hope for the best. Instead, they implemented several clever strategies designed to control the initial supply of coins and reduce the selling pressure. The most important of these strategies is the lockup mechanism. During the migration phase, users were given the option to voluntarily lock up a portion of their mined Pi for a set period, such as 6 months, 1 year, or even 3 years. In return for locking their coins, they received a boost to their mining rate. This lockup feature is a brilliant way to encourage long-term thinking. It effectively takes a significant amount of Pi out of immediate circulation. For example, of the 7.4 billion Pi migrated by June 2025, over 5 billion were locked up. This means that on launch day, only a fraction of the total migrated coins were actually available to be sold. This staggered release of coins over months and years helps to smooth out the selling pressure. Instead of one giant tidal wave of supply, it creates a series of smaller, more manageable waves, giving the market and the ecosystem time to mature and build up demand. Beyond just controlling the supply, the team focused on creating real-world utility for the coin. A currency is only valuable if you can use it to buy things. The team heavily promoted the development of applications and services within the Pi ecosystem. They launched initiatives like Pi Fest, which encouraged local businesses to accept Pi as payment for goods and services. By the time the open mainnet launched, the ecosystem had over 80 dApps for things like commerce, freelance work, and games. This strategy aims to create natural demand for the coin that isn't just based on speculation. The idea is simple. If people can use their Pi to buy a coffee, hire a freelancer, or pay for a service, they have a reason to hold onto it instead of immediately selling it for cash. This utility creates an internal economy, where the coin circulates and provides real value to its users. The more useful the Pi ecosystem becomes, the more people will want to acquire and use Pi, which in turn helps to support its price. This focus on building a functional economy is a critical defense against a price crash, as it shifts the narrative from when can I sell to what can I buy. Ultimately, the long-term price of any cryptocurrency comes down to two fundamental factors: trust and utility. Trust is the belief that the network is secure, the project is managed transparently, and the coin will hold its value over time. The Pi network built this trust over years by requiring strict Know Your Customer verification for all users and Know Your Business for all partners, like exchanges. This commitment to compliance helps prevent bad actors and reassures users and investors that the project is serious about security and regulation. This foundation of trust is essential for attracting long-term holders and serious investors. Utility, as we've discussed, is the coin's real-world usefulness. The success of the Pi ecosystem, with its growing list of apps and merchant adoption, is the key to creating sustainable demand. If Pi becomes a go-to currency for a global community of freelancers, shoppers, and small businesses, its value will be driven by its economic activity, not just by speculative trading on exchanges. The continued growth of this ecosystem is arguably the most important factor for Pi's future price stability and growth. A coin that people actually use every day has a much stronger foundation than one that is just bought and sold by traders. Despite these positive factors, anyone holding Pi should be prepared for significant price volatility, especially in the early stages. The initial launch period is often called price discovery, where the market frantically tries to figure out what something is worth. The price could swing wildly, going up and down by large percentages in a single day, as the first waves of sellers meet the first waves of buyers. This roller coaster ride is a normal, albeit stressful part of any major crypto launch. It is the free market in its rawest form, processing years of pent-up supply and demand in a very short amount of time. So, for any pioneer holding Pi, the decision of when to sell, or whether to sell at all, is a personal one. It's crucial to think about your own financial goals and risk tolerance. Selling immediately might guarantee a certain profit, but you might miss out on future gains if the price climbs. Holding on could lead to greater rewards, but it also carries the risk that the price could fall. There is no single right answer. The best advice is to avoid making emotional decisions based on short-term price swings, and instead focus on your belief in the project's long-term vision of creating a widely distributed and useful global currency.